Every investor you have ever admired once sat frozen over a $100 deposit button, heart drumming like it was a cliff edge. The distance between that person and $1 million is not luck, and it is not genius. It is 7 stages, in strict order, and almost nobody is told the order exists. Understand what this ladder is made of, because it is not made of money. Brokerages measure dollars. The stages measure who you become while the dollars accumulate. Fear, greed, humility, patience, nerve, boredom, and finally, ownership. Your account can jump a level overnight. The person holding it never can. One rule governs everything ahead. Stages cannot be skipped. They can only be shortened. Inheritances, bonuses, and lucky trades launch people 3 rungs up, and the ladder simply waits. Whatever stage your temperament lives in, your money eventually comes home to it. Remember that when the shortcuts start advertising. Stage 1. The tourist. Your first $100 goes in, and you are officially somewhere new. You know none of the language. Ticker symbols read like license plates. You own a sliver of something enormous and cannot explain what. None of that matters yet. The visa is stamped. You are inside the country. The tourist's first weeks pass in a fog of vocabulary. Expense ratios, dividends, index funds, tickers. Reading about money feels like ordering from a menu in a language you studied for 1 semester. You nod at words you cannot use yet. Everyone starts illiterate here. The fluent were simply lost earlier and longer. Then comes the first red day. The account drops $4 and some cents, and you feel it in your chest like a verdict. You research for an hour what happened, and the honest answer is nothing. Markets breathe. Nobody told the tourist that red is half of every heartbeat this thing will ever make. The tourist checks the app 14 times a day, at lunch, at red lights, once at 2 in the morning. Each open is a tiny slot machine pull of feeling. Up $2, euphoria. Down 3, doom. The sums are meaningless. The habit being formed is not, and it will need unlearning later. Then the first real gain arrives. $1.75. You screenshot it. You consider framing it. Veterans smile at this, but do not let them shrink it. That absurd little number is proof of a law you had only ever read about. Money, left in the right place, grows without your hands. The tourist's error is honest and universal, mistaking proximity for progress. Owning 3 shares does not make you an investor any more than a boarding pass makes you a pilot. Stage 1 ends the day you realize watching the market is not the same job as funding it. Most linger here for years. Stage 2. The gambler. It begins with a tip. A coworker's cousin knows a stock. A phone forum is certain. You buy with conviction money, more than the tourist ever risked, because this time feels different. Every investor alive has a stage 2 story. The only variable is the size of the tuition. The gambler concentrates. Why water a garden when 1 seed is obviously magic? Half the account, then more, flows into a single name, and your mood becomes a subsidiary of one company you have never visited. You check its price the way sailors check the sky. Identity and ticker begin to merge. That merger always ends. Somewhere online, a choir sings your holdings' praises around the clock. Rocket emojis, screenshots, certainty by the megabyte. Doubters get shouted into the parking lot. The gambler mistakes this echo for research. 1,000 people holding the same bag, cheering the bag, describing the bag as a parachute. The worst thing that can happen at stage 2 is winning. Your rumor stock doubles, and the win installs a lie at the center of your method. I can see it coming. You size up the next bet accordingly. Casinos comp rooms for exactly this reason. The market does the same thing, for free. Then the bill arrives. The certain winner drops 60% on a Tuesday morning, gapping down before you even wake. You watch conviction money evaporate in a chart shaped like a ski slope. This is market tuition. painful, near universal, and strangely necessary. What matters now is only what the pain teaches. Here is where the crowd thins. Most people leave through the stage 2 exit, telling everyone the market is rigged, a casino, a scam for insiders. Listen closely to the adults around you and count how many describe stocks with gambling words. That is not analysis you are hearing. It is an old wound, still talking. Stage 3. The student. Humility, freshly purchased, opens books. You learn what an index fund actually is. You learn that fees compound just like gains, in reverse.
You learn that the people who beat the market reliably are mostly a rounding error with marketing budgets. It is the least glamorous stage. It changes everything. The student's first assignment is an autopsy. 1 page, handwritten, on the dead trade. What you knew, what you felt, what you invented. The page is humiliating and priceless. You discover the research was a headline, the conviction was a mood, and the plan was a hope. Diagnosis is the beginning of method. Diversification finally clicks, not as jargon, but as self-defense. Owning a slice of everything means never again betting your family's future against your own judgment on a single Tuesday. The student stops asking which company wins and starts asking a calmer question. How do I own the whole race instead of one horse? One lesson lands hardest. A single percentage point of annual fees, compounded over a working life, can quietly consume a quarter of a nest egg. Nobody at the seminar mentions this math. The student rereads it 3 times, then checks the fine print of everything he owns in a single, furious evening. The student graduates the day the exciting portfolio dies. 12 clever positions collapse into a few broad, boring funds that own nearly everything. Friends call it giving up. It is the opposite. It is the first portfolio built on evidence instead of adrenaline, and it will outlive every thrilling one it replaced. Stage 4. The builder. The game changes shape here, because at this altitude, your deposits still outmuscle your returns. A $500 contribution beats most months of market movement on a small account. So the builder optimizes the only lever that matters yet, the savings rate, and automates it beyond the reach of moods. The builder develops one reflex worth more than any stock tip. Every raise triggers a bigger transfer before it triggers a bigger life. 3% more salary, 2% more invested, 1% enjoyed guilt-free. The account never learns your income stalled or soared. It only ever learns the transfers kept growing. The builder buys in all weather, and that is the entire forecast policy. Green day? Buy. Red week? Buy. Terrifying month? Buy. Scheduled purchases turn the market's mood swings from a threat into a discount aisle. You stop asking whether now is a good time, because for a builder, now is simply when the crane arrives. Run the builder's math once and never forget it. On a $20,000 account, a brilliant year of picking might add $3,000. Raising your monthly deposit by $250 adds the same, guaranteed, with zero brilliance required. At this stage, you are the best performing asset you own. Invest in the shovel, not the treasure map. Warning for Stage 4. Boredom arrives disguised as intelligence. The itch to optimize, rotate, backtest, and rebalance weekly. Every adjustment feels like work ethic and functions like sabotage. The builder's actual discipline is almost embarrassing to say aloud. Add money, own everything, do nothing. Repeat until wealthy or asleep. Somewhere in Stage 4, the portfolio crosses its first big round number, and the builder feels a click instead of a thrill. 10,000 invested is not wealth. It is proof of process. The scaffolding stands. The crane schedule works. From here, the plan needs only 2 things you already give it: deposits and years. Stage 5. The tested. It arrives without appointment, years in, when the account has grown into real money. A true crash, not a dip, a landslide. 6 figures of your compressed working life shrinking by the week. $30,000 gone in a quarter. The questionnaire said you could tolerate this. The questionnaire lied. Every crash arrives with its own soundtrack. Worst since the last worst. Trillions erased, screams the ticker, as if value were chalk. Experts who miss the fall queue up to predict the next one. The tested investor learns to read headlines like carnival barkers. Loud, paid by the scream, and gone by summer. A coworker sells everything at the very bottom and tells the break room he feels lighter. He is not wrong. Surrender is genuinely relaxing, but watch the sequel nobody films. He waits years for a safe moment that never announces itself, then buys back in higher, twice burned and half invested. Relief, build later, with interest. There is a night in every Stage 5 story. 2 in the morning, house asleep, cursor resting on sell everything. The math of surrender is soothing and exact. Stop the bleeding, sleep again. You sit with your finger on the end of your future, and, by some mixture of stubbornness and memory, do not press. Morning comes anyway. You keep the automatic buys running straight into the wreckage, purchasing shares at prices that will look like typos in a decade.
The crash eventually ends, as everyone before it ended. What remains is not just recovered money. It is armor. You now know your real risk tolerance. It has a scar on it. Understand what Stage 5 corrects. Every broker questionnaire asks how much loss you could tolerate, and every calm person overestimates. Real tolerance is discovered only in the presence of real numbers attached to real years of your life. The tested investor stops quoting the form and starts quoting the night he did not sell. Stage 6. The bored decade. The account crosses $250,000, then keeps swelling with a momentum that feels, frankly, unearned. Compounding has taken the oars. Some years the portfolio grows by more than every deposit you made in it. Your job shrinks to minutes per month. The challenge shrinks to leaving it alone. Stage 6 maintenance shrinks to a ritual. Once a year, on a date you chose for no reason, you rebalance back to the plan and close the laptop before curiosity starts suggesting improvements. 10 minutes, coffee included. The portfolio gets one appointment annually, like a healthy patient, and thrives on the neglect. A strange deflation sets in. The monthly deposit, once the engine of everything, now lands like a pebble on a moving train. Growth some weeks exceeds a year of old contributions. Do not stop the pebbles. They built the train, they steady the track, and stopping them retrains the oldest muscle you own backward. The strangest feature of Stage 6 is proportion. Investing, once a daily obsession, becomes smaller than your life. Weeks pass without a glance at the balance. Markets tantrum and recover behind your back like weather in another state. This shrinking is not neglect. It is the entire point arriving early. Somewhere in this decade, you nearly tell someone. The number has grown strange and beautiful, and pride wants a witness. You rehearse the sentence twice and swallow it. Money spoken aloud changes rooms, and you have watched it happen. The bored decade is guarded by a discipline nobody lists. Strategic silence. Stage 7. The owner. On an unremarkable morning, the account crosses $1 million, and in a good year it now earns something close to your salary without your attendance. You check the math twice, out of Stage 3 habit. Then you close the laptop and drive to work anyway, because that is who climbed this whole ladder. Read the 7th stage precisely. Ownership does not mean yachts. It means arithmetic has changed sides. For decades you fed the account with labor. Now it can feed you, indefinitely, if the withdrawals stay polite. Work becomes a choice reviewed annually instead of a sentence served daily. Nothing looks different. The floor under everything is different. The owner spends some of the harvest, deliberately, because a garden nobody eats from is just anxiety with foliage. A 6-month sabbatical, planned and funded, to learn wood joinery and walk a coastline. The account barely notices the withdrawal. You notice everything. Stage 7 money exists to be traded for Stage 7 time. One evening, a young coworker admits she has never invested $1, and you sit with her while she funds an account with one trembling hundred. You say almost nothing about stocks. You tell her the stages exist, in order, and that stage 2 will lie to her. The map, it turns out, was the inheritance. One last mercy to carry with you. Through all 7 stages, the market never once knew your name. It did not punish your gamble or reward your patience. It just moved, indifferent as tide, while you projected a drama onto it. The whole climb was never you against the market. It was you against you. From the 7th rung, look down once. The tourist with the trembling finger, the gambler with the ski slope chart, the student in the lamplight, the builder, the tested, the bored. All of them were you, and every one was necessary. The million was never the summit. Becoming someone a million could safely land on was. Since the stages cannot be skipped, shorten them instead. Fund the account weekly, and the tourist matures faster. Cap the gambling money at 5%, and stage 2 costs pocket change instead of years. Read before buying, and stage 3 arrives early. The latter charges everyone. It offers a discount for the deliberate. So find yourself on the ladder tonight, honestly. Still touring, still nursing a stage 2 wound you renamed wisdom. Building, tested, bored, or quietly landed. Name your stage in the comments, no balance required, and read what the rung above you wrote. Someone down the ladder needs your story more than your number.